Good morning, everyone. My name is Francis Sabourin from Richardson Wealth here in Montreal with Hassan Ghaffari Aram that works with me. Welcome to our Q2 2026 review on July the 8th, 2026. AI-driven growth amid economic uncertainty. Hassan, what really happened in this quarter?
Hello, everyone. I hope you are enjoying your summer. Yes, it was a very busy quarter. So we pretty much during the quarter, we had the largest oil shock to the market. So we had the war. Right now that we are talking, last night, the fragile ceasefire apparently struck again, and we have again a back and forth shooting in the Strait of Hormuz. So the price of the oil jumped up again 5%. Also, we have concern about longevity of the AI investment. The investors are now thinking how long this boom in the AI spending can last. We're going to talk about that a bit. And also about the inflation. Is this time is different? If we have a sustainable, are we going to have a sustainable inflation, or the inflation can be tamed? Also, the good thing that we saw in the market in the last 3 months was the broadening of the performance. So S&P 500 equal weighted was catching up with the S&P 500 market weighted. And last but not least, we have the record IPO. We're going to see the record IPO based on the dollar value in the year. In the graph that you're seeing here in the bar chart, you will see the sector performance in the quarter. Of course, the S&P 500 lead the TSX thanks to the tech. In our home country, Canada, the financial sector was the best one in the quarter, and you see the laggers and the beneficial of in the quarter for the Q2.
Good. Inflation is this time different compared to the last period that we had high inflation.
So if we go back after the COVID, when we hit the inflation of 9%, headline inflation of 9%, back then it was because of the massive fiscal stimulus, because it was the pent-up demand in the retail consumer and also supply chain disruption. This time around, it's a little bit different. So the inflation that we are seeing, if we cut out the energy shock that we had because of the war, the inflation, this time around, the inflation that we are seeing is mostly come from the investment, growth in economy. So that's the reason that why investors are not spook of that much about the inflation this time versus the 2022, 2023. They said that, okay, higher inflation going to bring higher interest rate, but all the investment that is happening now and all the economic growth that we're expecting going to compensate for the higher prices. So this is the fact that's happening right now. The question is how long that can last, and this inflation, how sustainable it is, and how consumer can like the regular consumers can sustain the higher prices. If you look at the chart, the first chart, U.S. inflation. By the way, we don't have the June data yet. We're going to have it next week, but the number that we have, the orange line is the headline inflation. The blue line is the headline inflation. As you see, there's a upward because of the war, energy. You can see the energy right in the orange line. The rest, which are service, food, and shelter, are not going up that bad. They're not going up like sharply. The only sharp increase was energy. And we know that the energy price is very cyclical. It goes up, the ceasefire happened, boom, it goes down. We'll talk about that. In the chart below, you see Canada and United States. So the orange and the pink one are Canada, green and blue United States. The orange line is the core CPI inflation, core inflation in Canada, versus the core inflation in United States, which is green. As you see, the green is in upward versus the Canada is in downward. So food is the food, shelter is the shelter. The difference in inflation in the United States comes from the economic growth. So we are buying the same food as the American. So inflation in the United States is not because of the material goods day-to-day things that we are experiencing in shopping. It's mostly about the growth of the economy. And if you see the unemployment rate, it's very clear now. The Canadian unemployment rate is much higher than the US. US, we're talking about the 4%. In Canada, we are talking about the 6%. So all in all, that tells us that the US is growing faster and the inflation is because of the economic growth. In Canada, we are lagging. Good news is, in the past 3 months, we show a little rebound in the Canadian economy. So you have the better GDP because of the better fiscal policy. But it's very early to say about the end of the year. Like 3 months ago, we were expecting about the GDP to be negative for the full year. Now we're expecting about 70 basis point positive GDP. So that's why the Canadian dollar is lagging a lot. So this slide was about the inflation. The bottom line is that inflation this time around is different because of the economic growth.
What about the fragile ceasefire, as we saw yesterday, in Iran, and inflation expectations for the coming months?
Exactly. This slide, we just made it an hour ago. We woke up and we saw this. There's again the problem in the Middle East, so we had to add this. So the point of this chart is this: how important is the price of the crude for inflation, and how important it is for inflation expectation. So let's start with the normal days before any war. At the start of the year, the graph which correspond to the oil price back then is the one which has like the hockey stick, like it starts from the low in the left, goes up to the right. That's a right chart. So Janvier, at the start of the January, the price of the oil was about, let's say, $57, $58, and the future trading price of the crude, the forward price of the crude was about 60. That's a normal crude. You buy cheap now, and the future is just a little expensive. That's a normal crude market. But right after the war, all the other colors that you see are the price of the oil, the future curve of the price of the oil. It's up at the start in the front lobe, and it's going down at the end of the curve. So right now, again, you see the orange line, we are in the orange line. So the May, April, June, it was about 100, 95, 110. So those was the day that there was a war. So it was a scarcity of the crude at the moment, but the market expectation was it's going to be solved. This is really the general understanding of the investors in the West, that when the commodity price, especially crude, jumps because of the supply shock, it will manage itself to come back because there's either ceasefire or solution out of it. When we talk about the inflation expectation, we're not talking only about the price of the crude today. We talk about the whole curve of the price of the crude. And Federal Reserve and the central banks wants to see how these curves behave. So that's important.
Okay, thank you. What about the economy per se and the consumers, especially in the US, which is very important to understand they are the driving force behind the economy?
US is 70% consumer-driven economy, and it's important to see how the consumer are doing. So the first chart is the fiscal policy. How much fiscal policy helped the US consumer in different years. 2023, 24, 25, 26. As you see, the black line, which is 2026, is higher and earlier. So people has more money sooner than the previous years. That was a support for the equity market. So that's one. The next one is the real GDP, the growth of the economy after cutting the inflation. That's a real growth of the US economy. As you see, we are at the 3% real GDP number. And right now, the blue bars at the bottom of the chart are all AI driven. Compare that to 2022. Right now, the big chunk, like about half of the growth, comes from the AI investment. Then you have the upper income consumption, the K-shaped economy, and then the rest of it. So it's very important to take into account that AI is a big part of the current economic growth. Then the question is, so what about that upper income consumption? Yes, rich people now feel they can spend more because they have higher wealth, mostly thanks to the stock market. Look at the graph. The black brown at the top of the graph shows the equity holding of the US economy, consumers. And that you see it's becoming fat and fatter. So that's why they have more incentive to spend.
Good. And what about the new tariffs a year later? What really happened?
So a year ago we had the tariff. So the tariff was always speaking, when you talk about the tariff, it's like, okay, if we put the tariff, the consumption we're going to go down. We're not going to buy more goods as before because the price is higher. Let's see if that happened. The total good import to United States, top left is the blue line. Yeah, it's lower, but you see the rebound. And where's that rebound come from? Computer and all the hardware, technical hardware. You will see, then the question is, so we cut the China, but where do you get the rest? You see the bottom graph, the red one, you received all the hardware from other parts of the world. We're not talking about what's happening really, is smuggling from China to other countries, but that's what's happening. The bottom line is this, we are getting what we need from other parts of the world. And then where does that really shows? In the durable goods. As you see in the up left, the durable goods import and orders are at the toppest level in the last 10 years. And manufacturing of the United States is very strong. Another reason to be very bullish on the GDP. You see in the right bottom, the ISM, Industrial Manufacturing Index, is high. So it's in more than 50, which is expansionary mode. This is very positive for the US economy.
So following up on this, what about corporate America versus the labor market, which is very important to make the economy running well?
Exactly. The main point is this. How is corporate America is doing? Just to give you an example, 2025, the market expectation for net income growth was about 13%. Last Q1 2026 too. They delivered 24%. So the question is, how do they do that? Look at this. The top of the graph, the chart at the top left, you have the corporate profit. That's all United States corporate profit dollar. And the blue line, the straight blue line, is the labor cost. As you see, the rates are increasing, but the profit of the corporate is much higher at the upper scale. So this gap is productivity. That's where the money goes for the corporation, for the stock market. Then I normalize that to show a second and the third derivatives of the change you see in the bottom. So the blue line again is the labor wage, the pace, the momentum in the wage, and the momentum in the profit of the US corporation. The profit in the US corporation starting mid-2025 is going up fast, whereas the momentum in the wage are stalling or going down. The difference is again right to the profit, net income, bottom line of corporate America. That's very important. So from the job market, is it scary? No. We're not talking about the layoff. We're talking about disallocation of the people or reallocation of the people. So this is very important. The unemployment rate is still at 4.5%. You have a huge leave from the labor market because of the baby boomers. 1.3 million in the last 18 months just left the labor market. So the labor market is still in a good shape. The very important question is this. If the economy grows faster because of the AI and people are not in a mass layoff, so is it going to change the natural neutral rate of Federal Reserve? That's very important. That's a rate that keeps nor cooling economy or making hot economy. That's a natural neutral rate. If the AI deliver what's supposed to deliver, we're going to see higher sustainable economic growth with a higher interest rate, which is safe and healthy.
Good. What about the record IPO that we saw with SpaceX? And as you know, SpaceX is becoming public. We have something similar to SpaceX in our portfolio. It's Telesat, is the satellite business, and we've been doing very well with satellites so far this year. We bought it at the right time, not the wrong time, in January, and since then it's been doing very well. So Hussein, what do you think about all these incoming IPOs?
Yeah. So when I'm pretty much sure you saw it in the news or newspapers. So a SpaceX, amazing company, came to the market. When you go to the history, the chart top left, when you have huge dollar value IPOs, there's a concern in the market that, okay, so IPO is, what's IPO? IPO is this: a company come to the market, tap the equity market, raise capital, bring it to the company for doing anything that they want to do. So so the liquidity will go from the market to the companies. So if you have these mega IPOs, 160 billion for the 2026, is it going to be headwind for the market because liquidity goes away? Yeah, in absolute term, if you see the dollar value, it's a record. But if you divide that 160 to the market cap, because the market in general also grew in the last 10 years, you will see we are not that stretched in the IPO divided by market cap. It's only 20 basis points. In 2000, it was about the 1%. So we are not in a stretch time at the moment. We're going to see OpenAI and Anthropic also come to the market. Expectation is that we will see, you see there's so many talking about the software companies now, but that's slightly to come to the market at the moment.
Good. And what about the credit market, which will be the harbinger?
Yeah.
So very important to understand the credit market.
So it's so common that if even you are the equity analyst or portfolio manager, but you don't analyze the bonds market, equity market, you're not doing your job correctly, because all the big companies are now tapping even credit market. Amazon last night, Google, Microsoft, not only in the US, all around the world. So they are tapping bond and equity market to raise capital for the future expansion. So that's a theme right now. I want to just emphasize something before going detail about the credit. Last slide, we talked about the IPO, which dry up the liquidity from the market. However, companies buy back stock, which is contrary to the IPOs. So by IPO, they issue the stock. By buyback, they buy back their stock. So based on the valuation that we have and based on the numbers that we get, we're going to have $160 billion IPO by the end of 2026, SpaceX plus the two others and a couple of others. But the buyback and M&A for 2026 going to be $1.2 trillion. So net, we're going to have around -2.5% less available equity in the market. So from supply and demand, it's positive for equity valuation. However, in the credit market, we're going to have around 4% more issuance. Credit market is a little different. Issuance is positive because there's some nuances there. But even with higher supply, the spread in credit market is still tightening. So that's a positive sign. The most important factor that we are careful about is not about valuation, number of the stock. It's mostly about the competition risk. We are in the market that AI is the leader, and AI divided to the software and hardware. So the market punished the software part, hyperscaler companies in the last 3 months because they say, oh, you're putting too much on CapEx, or the software is going to go away because of the AI. In the other side, they are cheering up all these equipment and memories providers. And the money of these parts comes from these hyperscalers. So if you punish these guys, at the end of the day, maybe they're going to cut spending. So the cyclicality of the equipment will come back. This is the concern. It's not happening now, but that's a concern that we have had. And it's shown in the valuation. Look, NVIDIA, for example, the PE of NVIDIA right now is at about, forward PE is 19. The average PE of this company used to be about 35, 37. So the market is a little worried about the future. Or look at Microsoft. The market punished them so much because they said, first, you are a software company. We are not agree with this. They are infrastructure software company. They're not kind of the software that you can replicate tomorrow. You cannot replicate Windows. You cannot replicate Windows or Microsoft software that you have, like the Excel of the Word of the world. And then they are hyperscaler. They have the cloud infrastructure. So the moment they show a little less capex, they capital and or they can rent out the capacity, you're going to see a huge markup in the profit, and you're going to see that it's come back. So that's important to understand. The valuation is not the concern at the moment, because even the very high prices are not expensive based on valuation, but competition is very important. Check for the Chinese competition. Check for any change in hyperscaler capital expenditure. This can be changed quickly and have a very severe effect on the rest of the market.
Good. And what's next, actually, with all a kind of conclusion on?
So it's very important to check for. It's very important to check about the competition first. So it's we do believe that we are back to the stock picking market. Index is not telling you the whole story. So stock picking is very important, and you have to follow the story of each company is based on competition and the supply chain. So that's very important. Then it's the wealth effect which comes from the AI is also important. So we show you the chart that how much is from the equity position that the consumer have, and they are spending based on the expectation that that's going to continue. That's very important to take into account. Fiscal policies, as we are at the risk, we are going to the election, we have some bond, so everyone is issuing the bond, so we have to take into account. Also, inflation pressure. Now this morning we have another oil jump. Inflation expectation is at our core concern. Right at the moment we follow it. All in all, we are positive because the GDP is growing, and the company, especially the company that we choose in our portfolio, are all cash positive, and from valuation perspective, we are not in any speculative mode. So that's what we think and we do.
Good. And thank you so much, Hassan. And obviously, for the last 12 months, we have been doing quite well, from easily 15% from our most conservative portfolio or model to up to 38% for our more global portfolio in Canadian dollars. Feel free to reach out to us, either myself, Hassan, Jean-Marc, Stéphane, Michael, Christopher, or Melissa. And also feel free to follow us on social media, either Facebook, Instagram, or LinkedIn. And if you want a copy of the presentation, feel free to reach out too. And thank you so much for your trust and confidence on us.
Thank you so much. Merci.